Tell me what legislative risk is and how did it become your focus when it comes to retirement planning?
Yeah. So when so many savers think about retirement, I've seen this in my own life with my parents and different peers and friends. What they're really focused on is a lot of times things that are specific to them. How much income am I going to need in retirement? What tax bracket that might put me in? How I want to cover my risk tolerance. But they forget that all of that exists in this ecosystem that's prescribed to us from Washington. And legislative risk is this emerging risk that I think the last maybe 10 to 20 years in politics has really sharpened in focus for me and advisors like you, which is this idea that at any time Congress can change the rules. And those changes can negatively impact our retirement approach. So it's not enough to just protect against market risk and longevity risk and the medical costs of aging. On top of that, we have to layer on, are we tax efficient in our retirement approach? And are we protected from these changes that could potentially come from Washington?
So, I had Mary Beth Franklin on recently, who's just a jewel of a human being, love her dearly, great contributor to the financial services industry. And we had a conversation about this, and she feels one way, I feel another, and that's okay. I believe that taxes will likely be your biggest expense in retirement. She said it's healthcare. I don't know if she's right or if I'm right. They're both going to be expensive. But what do you feel about taxation being a very potentially one of the largest expense that people will pay during their retirement?
Yeah. Well, what if I say that you're both right, actually? And a lot of the tax expense that savers could experience in retirement actually come not just from the personal individual income taxes that we pay, but also from these other kind of stealth taxes that we're increasingly seeing put on savers. So it's interesting, I was just at a conference speaking about IRMA. And for listeners that don't know, and I find people don't know about IRMA until they elect Medicare, IRMA is an additional fee that some savers pay on top of their Medicare Part B and Part D premiums based on their income. So the IR of IRMA is just an income related. That's that part of that acronym. And the reason I bring this both up is I think we are going to see twin risks coming out of Washington. One risk is this slow rise of taxes. And we can talk in a second about when that might occur, how that might occur. Today, we are in this kind of artificially low tax bracket rate environment because of the Tax Cuts and Jobs Act, which is, of course, expiring at the end of the year. But over retirement, and retirement is not about the next 4 years. It's about the next 10, 20, 30, 40 years into the future. Tax rates are going to rise based on demographics and spending in the country. And so one way that we have to prepare for taxes in retirement where they could have a big impact is if we have saved all or the majority of our retirement assets in tax-deferred vehicles, hugely popular vehicles like 401ks and IRAs and 403bs. We've made this bet that taxes in the future will be lower than they are today. If that bet doesn't come true, if that ends up not being the case, if our taxes are the same or even higher in the future, then that tax deferral doesn't pay off for us. So we need to first be aware of the risk of rising taxes. But the second twin risk, which in a way is connected to healthcare, is these other stealth taxes that the government is increasingly leveraging to generate more revenue. Things like increasing IRMA and surcharges on Medicare for many savers. So we have to watch both the traditional ways taxes can rise and the newer, more creative ways that Washington is providing for us. We have a revenue problem. Last year alone, the government in the last fiscal year took in about $4.9 trillion of revenue, which is a huge number. Unless, of course, you spend more than $4.9 trillion, right? So they took in $4.9 trillion last year. And on mandatory spending alone, spending that Congress and the president doesn't even control. Mandatory spending is things like Social Security, Medicare, interest payments on our federal debt, all things that are just codified into law that we have to spend. The government spent $4.9 trillion. So we're in this situation where the government is spending as much as it generates before we even get to the congressional process. That to me says taxes are going to have to rise long term, but also the government's going to have to get creative in new ways to generate income.
And I agree with you. It's interesting to me. The IRS, to collect one tax dollar, spends, and it's argued, between 35 and 40 cents of that dollar they collect to collect that dollar. That's when it comes to tax revenue, that's a very, very inefficient a collection method, right? Or the cost is very, very high. The margins are getting compressed by the IRS. And as a taxpayer, I want the IRS to have the best margins in the business, because that means that they're actually using my dollars for what my dollars should go for, instead of paying 80,000 federal agents to get guns and all that kind of stuff. That's all crazy. And that was going to happen, by the way. And maybe that's putting a stop to being put into that. But, one of the things that's really interesting to me is we're in arguably one of the best tax environments in history. Yet our country is approaching $40 trillion in debt. And I love to put that in context, Becky, because when people say that word, I don't think they understand what it means, right? So let's talk in terms of time for a second. 1 million seconds in time is about 2.5 weeks. 1 billion seconds in time is 32 years. And we're talking trillions of dollars here, right? So in your mind, tell me what you think. Is it likely that, we're able to not increase taxation in the future to overcome our debt, or the situation to where, tax is going to have to go up because tax rates are favorably low right now, yet government debt is extremely high?
Yeah. Most of our listeners probably remember when you didn't even think in trillions of dollars. Like, most people don't have a concept of it, because until very recently, that just wasn't a unit of measurement that our government had to deal with. Now, every year, we're running trillions of dollars just in deficit alone. The difference between what we brought in as revenue as a nation and what we spent last year was about $1.8 trillion. And as you mentioned, that has driven our debt to record high levels. The challenge is, when we look at how can we right this situation, right? It's not sustainable to have a federal debt that every year is growing 35 trillion, 36 trillion, 37 trillion forever. The ways that we can reduce that, though, are only through either reducing spending or generating more revenue. I think 1 trillion of that, or maybe even up to 4.4 trillion of that government spending alone, is just on Social Security and Medicare. So when we look at the demographics of our nation and how we have more citizens in the U.S. age 65 plus today than at any time in the last 100 years, they create a larger percentage of our population. The challenges that we are going to find as a nation with revenue are not actually Republican or Democrat issues. It's not political. We have a math and demographics problems. When you look at the demographic trends, we're going to spend more on Medicare. We're going to spend more on Social Security. And we all want that. We want those benefits that have been promised to us. But what that means is we have to find a way to pay for it. And generating new revenue, I think, is going to be the primary focus of our government over the next decade and beyond. Right now we are in this low tax bracket rate environment. And that's one of the reasons that I'm glad everyone's listening today, because we know this year in 2025, tax bracket rates are at these low levels because of the Tax Cuts and Jobs Act. Sometimes we call them the Trump tax cuts. Those are getting ready to expire at the end of this year. Now, Congress is hard at work to pass an extension, but one thing we've learned from that debate is that really the fiscal conservatives do not want to make these tax cuts permanent. It's very expensive to deny the government that much revenue. And so we're likely, if we get an extension, going to get a temporary extension of, let's say, maybe 5, or at the very outward end, maybe 8 years. Now, there's good news, bad news. The bad news is whenever these tax cuts expire, taxes are going to start to rise. We're about 30% lower on tax bracket rates for many Americans than we were before the reform. So I think tax bracket rates are going to normalize. But the other good news about that is we've been given a gift to do some planning now to prepare for what's ahead. So, I mentioned retirement is not about the next 4 years. It's about the next 40 years. And so in this low tax bracket rate environment, this is a critical time for savers to understand the potential retirement tax bill they have coming, make sure they're comfortable with it. And if they're not comfortable with it, make some adjustments now when rates are low.
Subscribe to Redefine Retirement on YouTube, Spotify, or wherever you listen to podcasts.